we now have proof directly from the Federal Reserve Bank itself that repo madness is getting worse. So while most of the people in the mainstream financial media talk about how reverse repos are now $1 trillion or more on a daily basis, on Wednesday, the Federal Reserve actually announced, and this was somewhat surprising to me, 2 new pawn shop locations, aka permanent repo facilities. Now, I was only expecting 1 permanent repo facility because that's all the St. Louis Fed has been advocating for. That repo facility is supposed to help with covert bailouts. They're supposed to take good collateral, but what we know from the reality of the Repo Madness situation in 2019 is the Fed changed a bunch of rules in a very short amount of time in 2019 during the Repo Madness crisis that lasted about 3 to 5 months approximately. Notice how that occurred only a few months before the stuff that happened in China in the Wuhan lab. So anyway, back then, the Fed was supposedly only taking good collateral, and the Fed's balance sheet back then went up $1 trillion in only a couple months. So this first permanent repo facility, which is a pawn shop, so they're supposed to take up to about $500 billion, although the Fed can always change that later, worth of toxic sausage or other types of collateral for emergency cash and loans. And that's supposed to be available for large domestic U.S. banks, money market funds, real estate investment trusts or REITs, hedge funds, and family offices. Well, now there's a second repo facility, and this might signal that the Fed is starting to expect something even more serious, perhaps a stock market crash or other countries attempting to dump their U.S. treasuries in the not too distant future. So this second separate repo facility, this second pawn shop, is set up for foreign central banks, where they can post as collateral either U.S. treasuries or other toxic sausage. So what is surprising to me is this second facility, because this is an admission by the Fed that they're expecting problems, counterparty problems, or funding problems by foreign central banks. Very similar to what happened in 2008 and 2009, how the Fed had to secretly bail out foreign central banks for many tens of trillions. We found that out with the one-time partial audit that Ron Paul got from both houses of Congress that they agreed to. Both political parties actually agreed to a one-time partial audit, and that revealed a lot of information. And then also the 2011 Bloomberg News Freedom of Information Act request that the Levy Institute then went through about 33,000 documents and found that $29 trillion worth of bailouts were given, an enormous chunk of which went to the European Union and large European banks and the European Central Bank to help bail out the European Union and large European banks. I think about 8 or 9 trillion of that 29 trillion. But the Fed back then bailed out basically the entire global financial system and a lot of foreign central banks and probably just waived the loans. Again, rules were changed and there was no real independent audit. And a very similar situation also happened not that long ago in February and March of 2020, where the Fed set up all these alphabet soup programs, including a couple different types of currency swap lines for dollars for foreign central banks that could post their treasuries as collateral without selling their treasuries, and then they could get access to cash or emergency liquidity or emergency loans very, very quickly without dumping all their treasuries. Now, these 2 pawn shops, these new repo facilities, permanent ones, they're not labeled permanent. They're called standing repo facilities, which is more obfuscation. They should just call them permanent repo facilities, but then that sounds bad. These will allow the Fed to covertly bail out those domestic entities that I talked about for the first facility. So there can be discrete bailouts, and then the Fed can pay 100 cents on the dollar and move those toxic assets and not have to put those toxic assets directly onto the Fed's balance sheet like the Fed had to do during the 2019 Repo Madness crisis, the first Repo Madness crisis, where the Fed's balance sheet increased by $1 trillion in only a couple months. That was a rapid increase. So I think the lesson the Fed learned is to not directly put this toxic sausage onto their own balance sheet, and now the Fed can stick this stuff off balance sheet legally, thanks to new rules changes in March of 2020 into special purpose vehicles. So I think with these 2 new permanent repo facilities, aka pawn shops, the Federal Reserve Bank can now do even more, even larger So in terms of size and scope, covert bailouts. And the Fed can also prevent other countries from dumping all their treasuries and creating a run on the dollar or trying to disturb the US Treasury market. So this is something else that the Fed, maybe they're anticipating this. Maybe they're expecting a stock market crash in the next 6 months or so. Maybe they're expecting a country that is desperate for cash to start dumping their treasuries. But this second permanent repo facility for foreign central banks is very interesting, and it reminds me a lot of what happened in 2008 and 2009, and also what happened in February and March of 2020. However, this time the difference is that the Fed can now legally stick trillions and trillions off balance sheet into new special purpose vehicles. So there's even less transparency and the possibility and availability for the Fed to do even more covert bailouts as part of stagflate tax lie. So the Fed can change the rules, the Fed can change what type of collateral, the Fed can change how much they give in terms of loans, the Fed can waive the loans, the Fed can keep the toxic collateral, the Fed can bail out hedge funds, the Fed can do covert bailouts like in Repo Madness 2019, paying 100 cents on the dollar for truly toxic garbage assets. And then the second repo facility for foreign central banks. And trust me, this is not what the taxpayer and holders of US dollars here in the United States would actually want. So this is another way for the Fed to not grow their official balance sheet while still doing enormous amounts of bailouts. And you're not going to hear anyone in the mainstream financial media or on Wall Street ask the Fed tough questions on this, especially given what we know about what really happened during the Repo Madness crisis in 2019. I was covering that extensively. There's an enormous amount of videos in the archives. There was a ton of bailouts of hedge funds that had really stupid, really enormous over-leveraged trades on bonds when Jerome Powell was talking about tapering and raising interest rates, and it broke a lot of hedge funds when the Fed started to reduce their balance sheet and hiked rates a couple quarter points. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content, research, financial education, and analysis, then I put in these free videos, including a lot more extensive research on global macro, far more extensive research on sectors like gold mining, silver mining, oil, uranium, precious metal royalty, and streaming companies, and bottom-up fundamental analysis of companies. There is a lot more in-depth analysis behind the paywall over on my Patreon for only $5 a month. I charge less than anyone else in the space for premium content. There is over 170 articles, charts, and audio podcasts behind the paywall, including 21 new articles out in the last 8 or so weeks on a lot of interesting global macro topics. So thank you for listening. So if I could wrap up this short little video, these two permanent repo facilities that the Fed has set up are exactly like pawn shops. However, unlike the astute pawn shop manager like you might see on TV for Pawn Stars, some of those reality TV shows, the Fed is willing to pay 100 cents on the dollar for really toxic garbage if it means protecting large banks and other key entities in the financial system like hedge funds and family offices, that if a couple of these failed, like Long-Term Capital Management or Ray Dalio's hedge fund Bridgewater, which was rumored to be over-leveraged in 2019, and also in February and March of 2020 with their over-leveraged bond trades with the basis trade and the risk parity trade and the leverage short vol trade, you just get reckless bailouts done with taxpayer money. And there's no transparency. No one's going to go to prison for reckless trades or handing out enormous sums to people who don't deserve it.